Buying and selling volume is determined by market participants. These are traders and investors that can range from individuals to large institutions and even computers. So the market is a collective of market participants, each with varying degrees of influence and reasons for buying and selling. So the market is just like a crowd. And just like any other crowd, certain influences will dominate more than others. For example, large institutional investors will be the most influential market participants most of the time, especially during major events such as earnings reports. Speaking of earnings reports, they're among the drivers of large amounts of volume, along with events such as share buybacks and major announcements such as when a company announces a new product or alterations to existing products and services. Other common influences include expected future growth, geopolitical events that often revolve around national and international risks to stability. There's also resource production, which often concerns refinement and inventories of resources such as metals and energy, which can often have a global impact even if traders and investors aren't directly involved with commodities. Resource prices can impact the stock market as well as currencies, and that highlights the complex interaction across different markets. Then there are economic reports such as employment rates and interest rates. All of these are common drivers of large amounts of volume, and yes, they are mostly all fundamental events. It's also equally important to take note of common causes of low volume. There is often little activity in the market near holidays, as market participants, just like almost everyone else, are taking a break. There can be very little trading taking place in the days leading up to a holiday when the market will be closed. And the same is true when there is a half day of trading near a holiday. Likewise, there can also be low volume in the aftermath of a major event, when the market is digesting what has just taken place and traders and investors are holding back, waiting for things to settle down. In general, there is low volume during times of uncertainty after a major move on the chart, and this is true for both fundamental and technical events, which we will get to soon. But first, let's talk about miscellaneous drivers of volume. These are reasons for buying and selling that are not directly related to the major catalyst events discussed earlier. These are common reasons why there can still be buyers and sellers during periods of low volume, and why there can still be sellers when the market is soaring, or why there can still be buyers when the market is falling. One reason could be market participants trying to scale in and out of positions. For instance, 100 shares of a stock could be bought, and then in order to capture more profits as price begins rising, more shares could be bought to scale up the position, or shares could be sold to reduce risk exposure. There is also dollar cost averaging. For example, an investor buys shares of stock at set intervals, perhaps each month, and this wouldn't be directly related to the common drivers of volume discussed earlier. On the other hand, there could be selling volume due to traders and investors cashing out their positions. This could be, for example, when a satisfactory level of profit is reached, or it could be done to reduce losses as price continues to decline. A position may also be liquidated or sold out of in order to use the cash for another purpose, such as buying another asset that seems more promising, using it for a major purchase such as real estate, a new home perhaps, or even to pay off debt. So drivers of volume can be highly individualized among all the market participants. However, in the end, there are a few key dominant influences that will drive the majority of the crowd, that is, the market. Charting provides a neat visual summary of this, and essentially, there can only be 3 actions where market participants can either buy, sell, or do nothing at all. In more concrete terms, actions such as taking profits and cutting losses can be understood with technical analysis by the examination of things such as key swing points, price ranges, and time frames, essentially looking for support and resistance. Uptrends and downtrends can be driven by a multitude of factors. Technical analysis allows this to be understood more easily by looking at the momentum and continuations of trends. For example, a gold mining stock could have its price increasing due to the rising price of gold, and progress in the exploration of new gold mining locations. When looking at the stock chart, the reasons for the price rising isn't as important as examining the trajectory of the incline and the accompanying volume.